All right, welcome to the deep dive. We're diving deep into the stuff you're curious about.
Yeah. We take your questions and we, like, uh, really get to the bottom of things.
That's right. We extract the knowledge that you really need to know.
And you become instantly smarter.
Instantly smarter. So today we're tackling, well, a pretty big topic, a cornerstone of investing, really.
Hmm.
We're looking at John C. Bogle's The Little Book of Common Sense Investing.
It's a classic.
It is a classic, and you, the learner, sent us some excerpts from this book and said, hey, dig into this.
Yeah, help us understand it.
Exactly. Unpack it for us. So our mission today is to kind of cut through, any of the jargon or complexity
Right.
and get right to the heart of Bogle's philosophy, which, as we said, is really about smart investing.
And how to make it work for you.
Yeah, exactly. Make it practical, applicable in your own life. So should we just jump right in?
Let's do it.
Okay, great. So Bogle starts off with a pretty interesting idea, this contrast between investing being a winner's game or a loser's game.
Yeah, right off the bat, he kind of sets up these two different ways of looking at the stock market.
So can you kind of unpack that for us? What's that distinction all about?
Sure. So the winner's game, in Bogle's view, is really about embracing the long-term growth potential of, well, of the entire stock market.
Duh.
Think of it as like investing in the overall economy. Businesses, overall, they tend to grow. They tend to become more profitable, right?
Makes sense.
So if you're owning a broad slice of that growth, well, you're kind of along for the ride. You're
Yeah.
participating in that upward trend. That's the winner's game.
Okay, that's intuitive, just ride the wave of the market going up.
Exactly, you got it.
Okay, so then what's this loser's game about?
So the loser's game is it's the constant attempt to beat the market,
Oh, I see. I see.
right? It's like picking the hot stocks, finding that superstar fund manager who's going to outperform everybody else.
Outsmart the market.
Exactly. And that's where things get a little bit tricky because it's just so hard to do consistently.
Yeah, Bogle uses a really interesting story to illustrate this, right? The parable of the Gottschalks family.
Oh, yes. That's a great one. So this family, they own like all the businesses in the world, right?
They're loaded.
They're set, they're rich, they've got it all. But then they start hiring all these like helpers to manage their wealth.
Right.
They
Yeah.
bring in stock pickers, then managers to oversee the stock pickers, then consultants to advise on the managers.
Oh my goodness.
Layers upon layers. And of course, each layer takes their cut, right?
Mhm.
Fees, trading costs, all that stuff.
Oh, yeah.
And Bogle, he quotes Warren Buffett here, which is brilliant. He says, for investors as a whole, returns decrease as motion increases.
Ooh, I like that.
Right. The more these intermediaries do, the more they trade, the more they charge, the less money actually stays with the family.
Yeah, yeah.
So the takeaway is it's not just about returns, it's about the net returns after you factor in all those costs.
Right, right. It's what you actually take home at
Yeah.
the end of the day.
Exactly. And this is where the power of compounding really comes into play, but in a negative way.
Oh, so.
Well, those small fees, they might seem insignificant at first,
Yeah.
but over time with compounding, they grow and grow,
Oh, I see, I see.
like a snowball rolling downhill,
Yeah.
but in reverse.
It's eating away at your gains.
It's a huge hidden drag on your long-term returns.
That's a really important point for investors to understand. Bogle seems to suggest there's like this inherent conflict of interest almost between the industry and the individual investor.
Yeah, that comes across pretty strongly in the book.
Can you elaborate on that a little?
Sure. So the investment industry, their whole model is built around activity. Right.
Trading, buying, selling, all that.
Exactly. Their motto is like, don't just stand there, do something. But Bogle argues that for most investors, the winning strategy is actually the opposite. Don't do something, just stand there.
Interesting. It's kind of counterintuitive.
It is. It's about resisting that urge to constantly tinker, to chase returns.
And minimizing costs.
Absolutely. That's key.
Yeah. So this leads to another surprising idea that a lot of investors actually end up doing worse than the market.
Yeah, you'd think with all the experts and all the fancy algorithms and all that, more people would be beating the average, right?
Right, you'd think so. But Bogle kind of debunks that myth, doesn't he?
He does. He points out that mathematically, the total returns of all investors combined has to equal the total returns of the market
Okay.
before costs, that is. It's
Yeah.
a closed system, right?
Yeah, yeah.
So for every winner, there has to be a loser.
Makes sense.
And once you factor in all those fees and trading costs that active managers charge, well, coming out ahead consistently becomes a really, really tough challenge.
Yeah. He throws out some pretty startling statistics, too, about how many actively managed funds actually fail to beat their benchmark.
Oh, yeah, that's a recurring theme in the book. He says something like 85 to 90% of active managers don't beat the market over the long term.
Wow, those are pretty rough odds.
Yeah, they are. And he's not alone in saying this. He brings in voices from the industry itself to kind of back up his point.
Interesting. Who does he quote?
Well, for example, John Bogle, who was the chairman of the Investment Company Institute, he flat out said that the average fund can never outperform the market in total.
Hmm, that's a pretty strong statement.
It is. He even quotes James Cramer.
Mad Money James Cramer.
That's one and only. Even Cramer has admitted that Bogle's arguments for index funds have made him rethink his whole approach to picking stocks.
That's pretty significant coming from a guy known for his, enthusiastic stock recommendations.
Yeah, it shows that even people deep within the active management world are recognizing the challenges.
Totally. So Bogle also makes this distinction between speculative return and investment return. Can you break that down for us?
Sure. So investment return to Bogle is the return you get from the actual performance of the companies you own.
Okay.
Things like dividends they pay out, their earnings growth, the fundamentals of the business.
But the real stuff, the actual business result.
Exactly. That's the engine driving long-term stock market gains.
Okay.
Now, speculative return, that's a bit different. It comes from changes in how the market values those companies.
I see.
So think about like price to earnings ratios, that kind of stuff. If investors suddenly get really excited about a certain type of stock, the price might go up even if the underlying businesses haven't actually improved that much.
Oh, so it's more about sentiment, like what people are feeling, rather than the actual performance.
Exactly. It's driven by expectations and psychology.
Which can be fickle, right?
Oh, absolutely.
Yeah.
Short-term market swings can be all over the place. So speculative return is very unpredictable.
Okay, and I remember he had a chart in the book showing how these two types of returns have played out historically.
Yeah, Exhibit 2.1. It shows that over short periods, speculative return can make a big difference.
Right.
But over the long haul, it's the investment return, the business fundamentals, that really matters.
So stay focused on the long game.
Yeah, that's the message. He emphasizes that corporate earnings are what drives stock returns in the long run, not just, the whims of the market.
Tune out the noise, focus on the fundamentals.
Precisely. He even quotes Ben Graham, the father of value investing.
Ooh, what does Graham say?
He made this really important distinction between investing, which is based on careful analysis and preserving your capital,
Okay.
and speculation, which is more about trying to predict market swings.
Oh, I see.
So Bogle's advice is, be an investor, not a speculator.
Don't gamble. Invest for the long term.
You got it. And this leads us to his big solution, his answer to this whole dilemma.
The index fund.
The index fund. It's all about the power of indexing.
Yeah. How does he explain that concept?
So he presents it as this really straightforward way to cast your lot with business, as he puts it. Essentially, you're buying a portfolio that mirrors the entire U.S. stock market.
Okay.
Or a broad index, like the S&P 500 or the Dow Jones-Wilshire Total Stock Market Index.
So instead of trying to pick individual winners, you're just buying a little piece of everything.
You got it. That way, you're not betting on any one company. You're betting on the overall success of the market.
And by doing that, you're pretty much guaranteed to capture the market's return, right?
Before costs, yes. That's the beauty of indexing. You're not trying to beat the market. You're joining it.
And there are some big advantages to this approach, right? Like lower costs, less trading, better tax efficiency.
Oh, absolutely. Those are some of the key selling points of index funds. They have really low expense ratios, which are those annual fees that mutual funds charge.
Right.
And because they're just tracking an index, there's very little buying and selling going on within the fund.
So that keeps transaction costs down.
Exactly. And it also makes them more tax efficient because you're not generating a bunch of capital gains from all that trading.
Makes sense. He also talks about the power of compounding, right? How even small gains can snowball over time.
Oh, yeah. He's a big believer in the magic of compounding.
It's amazing how that works, isn't it? Just let your money grow and grow.
Exactly. Time is your friend when it comes to investing.
He also points out that even some of the biggest institutional investors, like pension funds, have started using indexing.
That's right, which is a pretty big endorsement of the strategy, right?
Yeah, if these sophisticated investors are doing it, there must be something to it.
Exactly. And there's data to back it up, too. Exhibit 3.2 in the book shows the long-term returns of the S&P 500 and the total stock market index, and they've been remarkably similar over time.
So Bogle's point is owning the market through indexing is a pretty sure bet.
It is, as long as you're in it for the long haul. Trying to beat the market, on the other hand, is a much riskier proposition, especially once you factor in all the costs involved.
That brings us to one of Bogle's central arguments, the tyranny of costs.
Yeah, he's obsessed with costs. And for good reason.
Why is that?
Well, think about it. Every dollar you spend on fees, on trading commissions, on taxes, that's a dollar that's not working for you.
Right, it's coming directly out of your returns.
Exactly. So even if an active manager manages to pick some winning stocks, they have to overcome all those costs just to break even with the market.
And then some to actually beat the market.
Exactly. And as we've seen, that's a really tough thing to do consistently.
Yeah. He also talks about hidden costs, things that investors might not even be aware of.
Oh, yeah, those are sneaky little devils.
Like what?
Well, things like portfolio turnover costs, for example.
Yeah. What are those?
So when a fund manager is actively trading stocks within a fund, those trades incur costs.
Yeah, commissions and whatnot.
Exactly. And those costs get passed on to the investors in the fund, even if they're not directly visible.
Oh, I see.
And then there are things like front-end loads, which are sales charges that some funds charge when you initially invest.
Right, right.
So those can eat into your returns right off the bat.
Yeah. Bogle has a pretty powerful chart in the book, Exhibit 4.1, that shows how the impact of costs compounds over time.
It's a real eye-opener, that chart.
What does it show?
It basically shows how even small differences in costs can lead to huge differences in your ending wealth over, say, 30 or 40 years.
Oh, wow.
Yeah, the magic of compounding works both ways. Just like small gains can snowball over time, so can small costs.
That's a scary thought.
It is. It really highlights why minimizing costs is so crucial.
Yeah. He also quantifies the historical advantage of low-cost index funds, right?
He does. He shows how the S&P 500 has often outperformed the average actively managed fund by a pretty significant margin, and the lower cost structure of index funds is a big reason for that.
And of course, you have to factor in inflation too, which further erodes your return.
Absolutely. And again, low-cost index funds are better positioned to handle inflation than their higher-cost counterparts.
Makes sense. Bogle quotes Justice Brandeis in this section, saying something about arithmetic.
Yeah, he says the arithmetic of investing is unyielding. He's basically saying you can't escape the math. The numbers don't lie when it comes to the impact of costs.
Okay, so we've talked about costs, but Bogle also delves into this idea of the grand illusion, which is this notion that the returns reported by mutual funds are the returns that investors actually earn.
Yeah, that's a big misconception.
Yeah.
The reality is that the returns investors actually achieve often fall short of the reported fund returns.
Why is that?
Well, it's mainly due to two things: poor timing and bad fund selection.
Okay, can you explain those?
Sure. Poor timing means investors often buy into funds after they've already gone up in price, when they're hot.
Oh, so they're buying high.
Exactly.
Mm.
And then they tend to panic and sell when the market goes down, so they're selling low.
Buying high, selling low. Not a winning strategy.
Not at all.
Ah.
And then there's the issue of fund selection. A lot of investors chase past performance. They pick funds that have done well recently, but that's not always a reliable predictor of future success.
Right, past performance is no guarantee of future results.
Exactly. So you have this combination of buying high, selling low, and picking the wrong funds, and that can really eat into your returns.
Yeah. Exhibit 5.1 in the book really illustrates this, showing the difference in profit between investing in an index fund versus the average equity fund.
It's a powerful visual, that exhibit. It really shows you how much money investors can leave on the table by making these common mistakes.
Bogle also has a chart showing net flows into equity funds, and it seems like investors often pile in at the worst possible times.
Yeah, Exhibit 5.2. It shows how money tends to flow into funds when the market is high and then flow out when the market is low, which is exactly the opposite of what you want to be doing.
It's like they're following the herd, going with the crowd.
Exactly. And it's driven by emotions, by fear and greed.
Yeah. Exhibit 5.3 shows how bad timing and poor fund selection can really hurt your returns, especially with aggressive growth funds.
Those are the ones that tend to swing up and down the most, so they're especially susceptible to these timing errors.
So what's the lesson here?
Set a sound investment strategy and stick with it. Don't let emotions dictate your decisions.
Okay, so we've covered cost, we've covered timing and fund selection, but there's another important factor that Bogle discusses: taxes.
Yes, taxes. Those are a cost too, and they can be a big one.
How so?
Well, when you sell an investment for a profit, you have to pay taxes on those gains, right?
Right.
And the more you trade, the more taxable gains you generate.
So those actively managed funds, with their high turnover, they're not very tax efficient.
Exactly. They're constantly buying and selling stocks, which creates a lot of taxable events.
And index funds, with their buy and hold approach, they're more tax friendly.
Much more. They only sell stocks when the index changes, which is infrequent.
So they generate fewer capital gains.
Exactly. And that means more money stays in your pocket.
Makes sense. Bogle even quantifies the potential tax drag on actively managed funds compared to index funds.
Yeah, he does the math and shows how taxes can really eat into your returns, especially if you're investing in a taxable account.
So the takeaway is, be mindful of taxes and consider tax-efficient investing strategies.
Absolutely. Don't overlook the impact of taxes.
Okay, shifting gears a bit. Bogle also warns about the possibility of lower future stock market returns compared to historical averages.
Yeah, he suggests that future returns might not be as rosy as they've been in the past.
Why is that?
Well, he thinks that speculative returns might be lower going forward.
Okay.
Remember, speculative return is that part of the market return that's driven by changes in valuation, not by actual business growth.
Right, right.
And he thinks that those changes in valuation might be less pronounced in the future.
I see.
So if overall returns are lower, the impact of costs becomes even more magnified.
Exactly. In a low-return environment, every basis point of cost matters even more.
Exhibit 7.2 in the book illustrates how lower market returns could really hurt investors in actively managed funds.
It's a sobering chart. It shows how even a small difference in costs can lead to a big difference in your ending wealth, especially if the market isn't delivering those high returns that we've become accustomed to.
So the message is clear. Minimizing costs is more important than ever. Absolutely. And trying to pick winning funds based on past performance or relying on professional advice becomes even more unreliable in a low-return world.
So stick with what you can control. Costs.
Exactly. That's your best bet.
Okay, Bogle then challenges this whole idea of trying to select long-term winners, which is something a lot of investors are obsessed with.
Yeah, we all want to find that magic fund that's going to outperform year after year.
But Bogle throws some cold water on that dream, doesn't he?
He does. He shows that while there are always some funds that have done well in the past, there's very little evidence to suggest that they can consistently repeat that performance in the future.
So past performance is not really a good indicator of future success.
Not really, no. He even shows a chart in the book, Exhibit 8.1, that tracks the long-term performance of mutual funds.
What does it show?
It shows that very few funds actually manage to stay at the top for long periods of time.
Hmm.
And a lot of funds actually disappear altogether because they perform so poorly or they get merged into other funds.
So the odds of picking a long-term winner are pretty slim.
They are. Bogle even compares it to trying to find the one alcoholic in 20 who can become a social drinker.
That's a pretty striking analogy.
Yeah, it highlights just how difficult it is to consistently pick winning managers in advance.
And of course, there's the classic disclaimer that we all hear but tend to ignore. Past performance is no guarantee of future results.
Exactly. Bogle reminds us that those words aren't just legal boilerplate, they're a serious warning.
Yeah. He also warns against chasing short-term performance, like getting caught up in Morningstar star ratings or other recent performance metrics.
Yeah, he thinks that those can be really misleading because they put so much emphasis on what's happened lately.
Right. Recent performance doesn't tell the whole story.
Not at all. Exhibit 9.1 in the book shows some examples of funds that were top performers during the tech bubble in the late 90s, but then crashed and burned when the bubble burst.
Oh, right. Those high-flying tech funds.
Exactly. They were the darlings of the market for a while, but then they came crashing back down to earth.
So what's the lesson there?
Don't get caught up in the hype. Short-term performance can be very deceiving.
Bogle also talks about this concept of reversion to the mean.
Yeah, that's the idea that things tend to even out over time.
So periods of exceptional outperformance are rarely sustainable.
Exactly. What goes up must come down, as they say.
He even uses a coin-tossing analogy to illustrate how luck can play a role in apparent outperformance.
Yeah, he quotes Nassim Taleb, who says that if you flip a coin enough times, you're bound to get a streak of heads.
Right, but that doesn't mean you're a skilled coin flipper.
Exactly. It could just be random chance.
So how do you tell the difference between skill and luck in investing?
Well, Bogle quotes Ted Aronson, who says that you need an incredibly long time horizon to statistically prove that a manager's success is due to skill rather than just being lucky.
So it's really hard to know for sure.
It is, and that's why Bogle is so skeptical of active management.
Okay, so if past performance is unreliable, and even skill can be hard to distinguish from luck, what about seeking professional financial advice? Can that help us pick winning funds?
Bogle tackles this head on, and he's not very optimistic about the ability of most advisors to consistently beat the market.
Why is that?
Well, he cites studies that show that broker-managed funds have historically underperformed.
Hmm.
And he uses examples like Merrill Lynch's Focus 20 and Internet Strategies funds to show how hyped-up funds often fail to live up to expectations.
Right, those were supposed to be the next big thing.
They were, but they ended up being duds.
He even mentions that New York Times investment contest where professional advisors went head-to-head with a simple S&P 500 index fund.
Yeah, and the index fund won. The advisors couldn't beat it.
That's pretty embarrassing for the pros.
It is. It shows that even the experts can't consistently pick winning funds.
So what's Bogle's advice when it comes to choosing investments?
Focus on what you can control.
Costs.
Costs.
Yeah.
It's all about the costs. It is. He argues that cost is one of the few things investors can actually control in the investment process.
And low costs tend to persist over time, right?
They do. A low-cost fund today is likely to stay a low-cost fund in the future.
So it's a reliable factor to consider.
Exactly. And low costs are also correlated with better performance.
Really?
Yeah. Exhibit 11.1 in the book shows how lower-cost funds generally deliver higher net returns and better risk-adjusted returns.
So it's not just about saving money on fees, it's about actually earning higher returns.
Exactly. And of course, Bogle's favorite low-cost option is the index fund.
The index fund reigns supreme.
It does. It's the ultimate low-cost investment vehicle.
And he has a great quote about this. The more the managers take, the less the investors make.
That's a classic Bogleism. It sums up his whole philosophy.
Keep it simple, keep costs low.
Exactly. That's the path to long-term success.
So this brings us to Bogle's central recommendation, which is to embrace the majesty of simplicity through index fund investing.
Yeah, it's all about keeping it simple, sticking to the basics.
He really hammers home this point, doesn't he?
He does. He reiterates the logic of low-cost investing. He talks about how expense ratios can be as low as 0.10% or even less with some index funds.
Wow, that's practically free.
It is. And he shows a chart, Exhibit 12.2, that compares the costs of different S&P 500 index funds.
And even among index funds, there can be big differences in cost, right?
Oh, absolutely. It's crucial to choose the lowest cost options.
So even when you're indexing, you have to do your homework.
You do. Don't just pick the first index fund you see. Shop around for the best deal.
Makes sense. Bogle also talks about how broad market indexes like the S&P 500 have consistently outperformed the majority of actively managed funds.
That's a recurring theme throughout the book. The data really speaks for itself.
He addresses this misconception that indexing doesn't work in international markets, too.
Yeah, some people think that indexing only works in the U.S. market, but that's not true.
And he uses the example of Vanguard's growth and value index funds to show how even index fund investors can make mistakes.
Yeah, those funds were designed to let investors tilt their portfolios towards growth or value stocks.
Okay.
But Bogle shows how even those seemingly small deviations from a pure market cap weighted index can lead to underperformance.
So even when you're indexing, keep it simple, stick to the basics.
Exactly. Don't try to get too fancy.
Okay, Bogle also briefly touches on bond index funds and money market funds.
Yeah, he basically says that the same principles apply to those asset classes as well.
Low costs are still key.
Absolutely. He shows some charts, exhibits 13.1 and 13.2, that highlight the cost advantage of bond index funds.
So whether you're investing in stocks or bonds, indexing can be a winning strategy.
It can, especially if you keep those costs low.
Now, there are these newer types of index funds that have emerged, like enhanced index funds and fundamental index funds.
Yeah, they try to add a little bit of active management to the indexing approach.
What does Bogle think about those?
He's not a big fan. He thinks they're basically trying to have their cake and eat it too.
Ah!
Well, they're still claiming to be index funds, but they're also trying to beat the market.
Which, as we've discussed, is a really tough thing to do.
Exactly. And Bogle's skeptical that they can consistently outperform over the long term.
He thinks they're just chasing the latest fad.
Yeah, he's not convinced that they have any special insights or abilities that will allow them to consistently pick winning stocks.
He also talks about ETFs, exchange-traded funds, which are kind of like index funds, but they trade on an exchange like stocks.
Yeah, ETFs have become really popular in recent years.
What does Bogle think about them?
He's a bit cautious. He thinks they can be useful, but he's concerned about the high turnover that can happen with ETFs,
Turnover meaning.
meaning how often the underlying stocks in the ETF are bought and sold.
Okay.
And that high turnover can lead to higher trading costs and potentially lower returns.
I see.
He's also worried about the proliferation of narrowly focused sector ETFs.
Oh, like ETFs that just invest in tech stocks or energy stocks?
Exactly. He thinks those are too risky for most
Hmm.
investors.
So stick with broad-based index funds.
That's his advice. Keep it simple, keep it diversified.
It's interesting to think about what the father of indexing would have to say about all these new developments.
Yeah, he actually dedicates a whole chapter to exploring what Ben Graham would have thought about indexing.
What does he conclude?
He thinks that Graham, with his emphasis on sound investment principles and low costs, would have been a big fan of index funds.
That's a pretty powerful endorsement.
It is. Bogle even quotes Warren Buffett, Graham's most famous disciple, who's a big proponent of index funds.
So it seems like Bogle's philosophy is in line with the thinking of some of the greatest investors of all time.
It is. It's all about common sense, discipline, and keeping costs low.
So as we wrap up this deep dive into Bogle's classic book, what are the key takeaways for the learner?
Well, the first is the importance of understanding the difference between the winner's game and the loser's game.
Right. Owning the market versus trying to beat it.
Exactly. And Bogle makes a very compelling case that for most investors, owning the market through low-cost index funds is the smarter bet.
He also stresses the tyranny of costs, how even small fees can compound over time and eat away at your returns.
And he debunks some common myths, like the idea that you can reliably pick winning funds based on past performance, or that you need to be constantly trading to succeed in the market.
He's a big believer in simplicity, in setting a sound strategy and sticking with it.
He is. He provides some guidance on asset allocation, how to divide your money between stocks, bonds, and other asset classes.
And he emphasizes the importance of starting early, investing regularly, and staying the course through market ups and downs.
He even shares a story about a long-term Vanguard shareholder who became wealthy by following these simple principles.
So it's a really inspiring and empowering message, I think.
It is. It shows that anyone can achieve their financial goals with a little bit of common sense and discipline.
And it all starts with understanding the relentless rules of humble arithmetic.
Exactly. That's what Bogle calls it. The math doesn't lie when it comes to investing.
Well, on that note, I think we've covered a lot of ground today. Hopefully, the learner has a much better grasp of Bogle's investment philosophy and how it can be applied in their own lives.
Yeah, we've gone deep.
We have. And as a final thought, something to ponder. Think about the constant pressure within the financial industry to create new and complex investment products.
Right. There's always something new and shiny being marketed.
Exactly. And ask yourself, does this constant innovation always serve the best interests of the average investor?
It's a good question to consider.
It is. We encourage you to dig deeper into the historical data to compare the performance of actively managed funds versus simple index funds.
Yeah, do your own research.
And pay close attention to those seemingly small fees because over time, they can make a huge difference in your ultimate investment outcome.
It's all about the long game.
It is. Thanks for joining us on this deep dive into the world of common sense investing. Until next time.
See you then.